Hello, dividend growth stock investors. Happy Sunday to you. It is Colby, the DGI Crab. Are we having fun yet? Markets continue to crash. There is panic on the trading floor, and that means there's going to be plenty of value for us to go over and dissect amongst the 60 dividend growth stocks that this channel focuses on. That is right. I have taken just 60 dividend growth stocks and split them into four separate categories or tiers based off of the age and time horizon of the investor, which I believe is the most important metric a dividend growth stock investor should be taking into consideration. How much longer do you have until retirement? Should you be looking at those high yield, slower growth moves, or should you be looking at lower yield, high growth moves? Well, your age and your time horizon should dictate those decisions, if you ask me. Now, I'm not a legal professional financial advisor. The content of the channel should be considered primarily for entertainment, and the opinions expressed regarding investments are my own. You should always perform your own due diligence prior to investing any of your hard-earned money. For the newbies out there, this is how I invest my money, the DGI Crab allocation strategy. I put 50% of my money each week into age-appropriate ETFs for automatic diversification. I'm looking for stocks that are yielding at least 30% or more above their 4-year average yield. I have a separate category for my top 10 favorite stocks. If they're yielding 20% or more above their 4-year average yield, I will buy them regardless of what age tier I've placed them in. Now, I will remain within my tier unless there's a stock in a different tier yielding 50% or more above their 4-year average yield. Of these 60 stocks, we're up to 5 of them right now that are yielding 50% or more above the 4-year average yield. One of them is yielding more than 100% more than the 4-year average yield. Bet you all can guess which one that is if you've been around for more than just a few weeks. And if there's not a buyable stock within my tier, I'm not going to invest less. I will just put more money into ETFs for that particular week. But with the stock market being down as much as it is, there are plenty of bargains to be had in each and every tier. So as we hop over here into the spreadsheet, I have these sorted by valuation metric, which is where I am taking the current day yield, comparing it to the 4-year average yield, and figuring out how far off the current day yield is from the 4-year average yield. If we've got stocks in the green, they've hit that 30% or more threshold. All the other stocks that are not in the green, I don't sell those off if they're in my portfolio, which all of these are. I will just simply hold, let the dividend reinvestment do its thing, let those runners run. Now, one of the things that I thought about on this particular strategy was that if there was a major market correction, like we're seeing right now as a result of the Trump tariffs that were recently put into place, that some of the stocks that were already down quite a bit would not have as far to fall. And that has not particularly worked out very well in the case of Nike, which has been the most undervalued stock in tier one ever since I began the channel last summer, and it has continued to fall. Now, Nike is directly impacted by some of these tariffs that are put into place, particularly on tariffs on Vietnam, which is where Nike has a lot of their manufacturing done. So Nike yielding 2.79%. The 4-year average has climbed up gradually up to 1.24%. We are every single week getting rid of 2021 yield data. So I'm going back 4 years. 2021, stocks were yielding low. It was a very hot year in the market that year after all that money printing. And what we're going to find is these 4-year averages are going to continue to consistently climb up when comparing that to, or pairing that with, I should say, the higher yields that are happening right now. So Nike and Nordson very much in the buy zone right now. Nordson, I thought, was a great value in the $200 to $210 range. It has plummeted all the way down to $176 in the past week. The Dividend King is looking very much on sale, yielding 1.77% when the 4-year average yield is just a smidge below 1% even. And then we've got a new one here, you guys, in the Tier 1 category, analog devices. If you want some tech exposure in your portfolio, yielding 2.41%. The 4-year average yield is at 172. I thought we'd take a quick look here at analog devices here on Seeking Alpha. We're going to go over to the dividends tab here and take a look at the dividend growth history here. If we scroll down here and look at the dividend growth over the years, going back to when they began their dividend payout and started their streak, which hasn't been broken, they did some very large dividend increases in the beginning. And then you can see here, even through the financial crisis, 2008 and 2009, they continued to do smaller dividend increases, got that back up into the double digits once we got out of that particular mess. Pretty steady from 14 to 18. We see mid to high single digit dividend increases, and then a lot of double digit increases from 2019 all the way up through 2023. Last year, 2024, just shy of a 7% increase. Still not too bad overall. Analog devices, maybe not a household name, not one that you've heard a lot about if you're looking at the different YouTube channels here, but they've got a very comfortable payout ratio of 59%, a 5-year growth rate well above 10%, and a dividend growth streak of 21 years. So I like analog devices right now at the current prices. If you're tired of buying Nike, if you're not a believer in Nordson, maybe take a look at analog devices. And then Microsoft, so long as Microsoft is yielding really anything above their 4-year average yield, which they are, I think this is a good, safe bet as a stock that's going to eventually recover, regardless of what any presidential administration happens to do. Moving into Tier 2 for the age 31 to 41-year-old investors, we've got 5 stocks that have hit that green category, with Target remaining well on top of this particular heap. Target is a top 10 holding now in the very popular SCHD ETF. And I think that now there's been a lot of people who have been selling off SCHD lately, if you can believe that. But that being said, I think Target yielding 4.68% is going to be paying you far too much money in dividends for you to complain about waiting around for them to recover. I think this is a great value right now. Obviously, if you've been around for the last few months, I've been excited to continue adding Hershey. It's been down for quite a while. Still looks like a solid value to me. Next Era Energy down here in the mid 60s. Very excited to add this one. And then Starbucks, man, I remember buying that late in the summer, early fall when it was down here in the 80s and the 70s. It shot back up to more than $100 a share, and now it has been blasted yet again and is back down into the buy zone. I'm happy to go back into Starbucks now and start adding to it again. And then Texas Instruments. Now, one thing about Texas Instruments that worries me is their payout ratio has stayed really high. It's still up here at 102%. That is worrisome to me. I do love the company. The stock has a fantastic track record of increasing dividends year over year. I am probably okay rolling the dice here on Texas Instruments, getting that yield comfortably above 3.5%. Lots of value to be had here in Tier 2. Now in Tier 3, the 42 to 53-year-old investors, we've still got 5 stocks in the buy zone here as well. Pepsi, one of my top 10 favorite dividend growth stocks of all time, is still in just the normal buy zone, hitting that 30% or more threshold. Archer Daniels Midland, still way down. T. Rowe Price, how much further can T. Rowe Price fall? It was yielding 5.5% last week, trading in the $90 per share range. Now it's fallen all the way down to 82. Wow. T. Rowe Price really getting major yield here at 6.15%. I almost can't believe it myself. Hormel, genuine parts company, 2 dividend kings, still trading well off of their 4-year average yield. You guys can get a lot of dividend income bang for your buck this week in Tier 3. For Tier 4, the age 54 and older investors, we've only got 10 stocks here. It is not easy to find higher yielding stocks that still have a respectable dividend growth rate and dividend growth streak. These were the 10 that I thought were the best of the bunch. And we've still not seeing anything in that 30% category. Realty income, I think when realty income yield top 6%, that's a pretty decent play if you're looking to add some real estate to your portfolio. Prudential Financial fell really hard over this past week. It's jumped all the way into the number 2 spot on this list, surpassing NNN REIT. Keep an eye on Main Street Capital, one of, if not the best BDC that you can purchase for high monthly yield. It's yielding above 8% right now. I'm probably going to wait for Main Street Capital to fall below $50 a share before I start really looking at it that hard, but it's certainly one to keep your eye on for right now. Now, the strategy as it plays out, now I say, guys, I do 50% of my new money that goes into ETFs, so I don't have to worry about overall diversification with my single stocks. I've got it with the ETFs. So long as my portfolio is 50% or more in ETF weighting, should be pretty good as far as diversification goes. Now, for Tier 1, I do 25% into the S&P 500. Now, you can swap out an ETF here. These are just kind of suggestions, the ones that I personally utilize. You can do SPY or IVY. There's different ones that are out there, but as long as it's an S&P 500 fund, I think 25% if you're in Tier 1 is a good amount of money to have in your S&P 500. I do 15% into a small cap ETF like VBR. And I think starting to get a VIG position established if you're in the younger tier here, about 5% of your money, not a bad idea to at least get the ball rolling there with dividend appreciation. And then I do VYMI for my international investment all the way across the board through all age categories. This is the only non-US investment that I make. Tier 2, same 4 ETFs, different weighting, 25% into the dividend appreciation, 15 S&P 500, and 5 in the small cap. For Tier 3, I go SCHD as the primary one here. I also like VYM and DHS in this category. All 3 are excellent. All 3 employ somewhat different strategies from each other, but all are excellent dividend growth plays for the 42 to 53-year-old investor. And for Tier 4, for stock exposure, I still go with SPYD, low expense ratio, highest 80 yielding stocks in the S&P 500, very stable, not anything you're going to have to stay up at night worrying about, should provide good solid dividend income. And then I go with some of these alternative investments that provide me with higher yield, and it's stuff that I don't have exposure to if I've been investing in this way in my younger years. So stuff like SPHY for high yield bonds, PFFA for preferred shares, MLPX for MLPs, and then my 3 favorite covered call ETFs, Devo, JEPQ, and SPY-I. JEPQ for my NASDAQ 100, SPY-I for my S&P 500, and then Devo is just such a great covered call ETF providing both yield and growth. And then for the stock strategies, if you guys want to hit everything in the categories here based on the way that I personally purchase, Tier 1's going to hit Nike, Nordson, ADI, and Microsoft within their own tier, grabbing Pepsi, Target, Hershey, and ADM as the undervalued stocks outside of the Tier 1. Tier 2 will hit Target, Hershey, NextEra, Starbucks, and Texan within the Tier 2 category, while grabbing Pepsi, ADM, Nike, and Nordson outside of their own tier. Tier 3 will do Pepsi, ADM, Hormel, GPC, T. Rowe, while grabbing Target, Hershey, and Nike outside of their tiers. And maybe you could even go Nordson here if you wanted. And then for the Tier 4 folks, T. Rowe Price yielding above 6%. That's a high enough yield, even if you are a current income seeker at 54 years and older. I think T. Rowe Price will eventually give you better dividend growth than it's done within these past few years. But man, it really has fallen a long way. So I would understand if you wanted to just stick more into the ETFs. So that is it for the week, you guys. Take a deep breath. Do not panic. Be excited about buying high yield right now. Until next time.